Hello and welcome to this session where we will be discussing limited partner allocations and bias to Asia and what has changed. I'm Deepshikha, Monga, an editor at DealStreetAsia, and today I'm joined by two esteemed investment professionals. Hemal Mirani is a managing director at HarbourVest Partners, a global private markets investor with more than $80 billion in assets under management. Hemal spearheads the firm's operations and strategy for Singapore, as well as Beijing, Hong Kong, Seoul, and Tokyo. Welcome, Hemal.
Thank you. It's a pleasure to be here.
And we have Sunil Mishra, partner primary investments at Adams Street Partners, a global investment manager with $45 billion in AUM. Sunil specializes in fund selection, due diligence, negotiations, and monitoring of Asian investments ex-China, specifically in India, Australia, Japan, Southeast Asia, and Korea. Welcome, Sunil.
Happy to be here. Thank you very much.
All right, let's dive right into the discussion. LP allocations to alternative assets are going up as these investors look for higher yields in a low interest rate environment. How much do you think Asia could benefit from this trend, given the track record of fund managers in the region and the exit landscape? Sunil, maybe you could take this first.
Oh, absolutely. So what we see globally, there is a higher demand for alternatives, and clearly a lot of capital is going into private equity, even private debt. And I would say Asia's share of this global allocation has been going up over the last 15 years. We have seen that in our own allocations and broadly in the market as well. We think that Asia is reaching, in terms of size, scale, depth, and maturity, a stage where it probably will attract more capital as there is more experience in the manager, there are more exit avenues, and just I would say in general maturity of the private markets to take such capital. So we're expecting these allocations to go up. That is from the allocation point of view. But if you look at it from a secular and I would say economic growth perspective as well, Asia is kind of driving much of the global growth at this stage. Almost 2/3 of the global middle class is in these markets. There are $5 trillion economies here. So really large economic activity, which is also going on, which is what long-term investors would like to see, would like to invest in. So I think in general, we expect the allocations to go up. That's how we are kind of allocating to Asia. And we'd love to kind of hear what Hemal is saying, but it's an interesting phase for the market.
So I completely and wholeheartedly agree with Sunil, and this may end up being one of those sessions where we're in profuse agreement about things. But I'll just add a couple comments to what Sunil said. I think across the world, when you look at private equity allocations, venture and growth is one of the places that has seen a significant amount of growth in terms of investors wanting to allocate capital and continuing to see the kind of companies that have grown in the region. And Asia clearly is a big piece of the answer over there in terms of new business models that are coming out, in terms of the ambitions that have been created by the successes that you have seen out here in the region. And while I've been evangelizing about Asia for a long period of time, it feels like the world is beginning to hear what Sunil and I are probably seeing out here in the region with regard to the talent that we've got over here, the entrepreneurs that we've got over here, and really building, solutions for Asia that will look different from the rest of the world, but really, really good businesses and GPs to continue backing out here in the region.
Sure. How much of an impact did COVID make, if at all, to the way investors look at this region? Hemal?
So, I would say it was sort of it's been an interesting, 18 months, 2 years, right? Where when you look back at, last year and the beginning of COVID, where Asia was a lot more impacted, and there were a lot of concerns and questions coming really about, oh, what's the impact on the portfolio? Can you tell us what you're going to see? And as COVID sort of started spreading, it became something that the whole world had to deal with, not just Asia in terms of doing that. But I thought it was quite interesting how seamlessly we moved to the Zoom world, right? We're recording this conversation on Zoom, whereas in that old world, it would have been, are you flying out to Singapore? Are you going to be over here? You're clearly, asking questions sitting in another part of the world. So I think that, ability to seamlessly move into continuing to make investments, continuing to build on relationships. And frankly speaking, it broadened, I think, participation for a lot of investors who may not have had, budgets necessarily to travel that far, or who may have had interest in a strategy, but never had the opportunity to hear. So as GPs opened up and invited more people to participate in Zoom, you were hearing more about stories in terms of successes out here. You were broadening your world, ironically, while not being able to travel. And I think in some ways that was a good way to deal with what was not a great situation in terms of that ability to communicate and continue with the commitments that we were making. So, I think where it probably had more of an adverse effect was new relationships were harder to form over Zoom. Whereas if you had built relationships and maybe not committed to a GP, you were more willing to take that step, or your re-ups were continuing to be easier because you'd built the time and you'd had those relationships to be able to do that. And, I know at HarbourVest, what I can say is just, having offices in the region over here helps, right? That you have a partner sitting in China who can do that for you while you're under lockdown. So I think all of us got very creative and innovative in terms of doing our jobs and finding a way to keep that pace going. I'm sure Sunil will agree with me that, despite COVID, last year and this year have been very, very busy years in terms of making commitments to GPs in the region.
No, absolutely agree. Did not expect it to be as busy as it turned out to be, but we have been very busy in 2020 and even in 2021, and I don't think 2022 is going to be any lighter. So I would say good exit markets and liquidity, and there's pretty much record distribution that all of us are seeing has meant that most of the investors have continued to invest in the asset class. I think there are only two to three things that I'll add to what Hemal mentioned. One is, still a lot of institutional capital sits in the Western world. And, while Asia is coming to a size and scale, there is still quite a few emerging managers kind of in these markets. And COVID has definitely done what I think is kind of flight to familiarity. So, people whom we knew, we were more easy to back, especially on what we call primary investing, which is kind of blind pool investing. So some people have suffered, we all learned this K-shaped recovery. There are gainers and, losers. I think there is a little bit of loss there. But, people who have done well and people who have, as Hemal said, moved to the Zoom world, were able to kind of, get investors comfortable that they can operate and they can find deals. They have teams on the ground, they can actually execute, have continued to gain. So industry has continued to expand. But, I would say slight limitation for certain people who have not been able to either get to the investors or be able to get in front of investors or be able to execute in this environment. So they have kind of, lost a little bit during COVID.
Okay, let's talk about China. The regulatory crackdown in the country has had many investors spooked. We've seen an LP, US pension fund CalPERS, recently being asked about its exposure to China at a board meeting. Do you see more LPs raising concerns about China, and what could it mean for investment firms' plans in the market? Hemal, again, could you take that first?
Sure. So, let's, I think, take a step back, right? I know we're talking about China and regulations. There are regulations all across the world. And frankly speaking, all investors in different shape and size need to deal with regulation and need to understand risks in terms of markets that they're going into. I think we're still in the middle of a change that is possibly taking place in China. And I think today, for anyone to say and make a very bold decision that I am not going to do this, or I am only going to do this, it's a bit too early, right? Let's give it time. Let's understand what is going on. Let's understand where the regulators want change to take place before we make decisions. I'd say that, on the alternatives and the private equity side, all of us, that have built portfolios, that have built relationships, that have gotten the rewards of investing out here in the region, all through time have understood that there were risks over there. We haven't done it, without risk. You will remember that backdoor listings at some point, were the rage, and that went away. Cybersecurity was an issue even previously. So some of these things are things that we have dealt with over time, and I think patience is required. Working with GPs who understand the landscape locally in terms of navigating through some of the changes that are coming, and people that you have confidence in. I also think relationships that we build with these GPs are built over 10, 15, 20 years. Sunil and I work very hard to get allocations to these top performing GPs. Unlike the public markets where you may choose to have lower exposure and you can do that in a much quicker way, I think in the alternatives, we're patient capital. So we tend to have longer hold periods around some of this. And I think you've also got to sit to say that, despite all the crackdown and maybe some of the risks that are out there, it's also been a much better valuation environment, right? So don't look at it just from the perspective of, should you cut allocations? To the extent that you are here and you believe in the markets, it's also an opportunity to sort of work with your GPs to say, where is their true value now that maybe pricing has fallen? And how do I continue to get access to what I'm building? So, it's a topic we should all be talking about. It's a topic that we should all, be learning more about. But, I hesitate to sort of say that, we're going to be, LP should be cutting back allocations at this stage in terms of China. Sunil, I'll hand over to you.
No, I'm full in agreement. We are long-term patient capital. We don't make tactical changes to our portfolio on a daily basis. Right now, we are in the midst of several announcements that have come. I think everybody is digesting that and understanding what the course of that action is. It's not that easy. It's a large economy, and in terms of market, it's a very attractive market. We've done really well. We have team on the ground, and we have had very successful track record. And even before any of these happened, means if you look at what are the elements that make for long-term successful private equity market, there are a lot of features were present. So we remain excited about it. Clearly, in the really short term, we're trying to be cautious and understand what it means and how we should play the market. Every crisis has an opportunity. And we are in company of some really sophisticated managers who are basically will be able to find ways to invest. We'll have to see. I think it's very early days to be able to conclude. Like I said, we have done well, and we remain committed to the long term.
I'd say, Deepshikha, one thing I'll add is, when we look at numbers that you put out, right, in your newsletter, and you look at the fundraising and you look at the investments, China accounts for 50 to 60% of the fundraising that takes place in the Asia Pacific market, as well as the investment side, right? And so if someone sort of says, I'm not going to do China, you sort of sit there going, for a region, would you only look at 40% of the market when there clearly are opportunities over there, right? So I think that, statement that Sunil and I both made about being patient and long-term investors is really the key in terms of approach, and really thinking and learning as we go along in terms of what one should be doing at a time like this.
Okay, what other factors would make LPs cautious about investing in Asia? And you're both fund of funds manager as well, so you look at funds in the region as well. So what have been some of your concerns about putting in more capital for Asia Pacific?
Sunil, do you want to go first?
Yeah, I can go first. I would say, 2-3 things. One is, some of the markets in Asia, clearly, we have spoken a lot about China, but it's a large, deep market, both from, capital deployed perspective and also in terms of exit and exit avenues. As an LP, I think, we are extremely exit focused, so we want to be in markets where there are, deep exit markets which are possible. So I think that probably is one of the key criteria that we look at. And second is, you can have a lot of macro attractiveness, but if you do not have experienced managers, that macro story never becomes LP returns. We are very, very mindful of that. So we want to see people who have had some level of experience. So I think those would have been two of the major reasons, why we have evaluated certain markets and have decided that, we need to continue in tracking mode, or we need to kind of, get into an active investment mode. And of course, the third point is, we have global portfolios, and, still we invest up to 60% of what we do annually in the US, and US has done really well. So, our business is about relative assessment, getting the best risk return for our clients. And, we build global portfolios as well. So, with that perspective, we are seeing our Asian allocation increasing, but it has to kind of sit alongside some of the other attractive returns we are making in the rest of the world.
Yeah, I completely agree with Sunil over there. So Asia's got to stand on its own feet in terms of returns, because you're going to move capital allocations. You have to justify it, and we all have investment committees that we've got to have these discussions with in terms of doing that. But I'd say that exits and liquidity has always been a question that everybody asks. I think if you look at the last several years and you look at the returns that have been generated, I don't think today you can sit here and say that it lags the rest of the world significantly in terms of doing that. So I think there has been a lot of development that has taken place, but clearly we're all returns focused, and cash is king, as we all say, in terms of what's got to come back to all of us in terms of making that assessment. I'd also say that, it's very hard to sit that far away and try and do this without coming out to the region. So, for a lot of investors that maybe don't quite have the ability to travel often, don't have the ability to come out and regularly do these meetings, change in China takes place very, very quickly. So if you're not a regular visitor over here, it just is very hard to keep up with some of the changes that are taking place in China and the development of the rest of the region. So, I would encourage people that want to build portfolios and continue to have allocations to the region, clearly post-COVID, to find a way to be coming out here and building relationships over here.
Do you see Asian LPs also stepping up and filling in that gap that you talk about from lack of familiarity with the market, people being far away, not having boots on the ground? Is that happening as well?
So I'd say, when we've looked at sort of a lot of the experience of LPs, generally speaking, right, most LPs want to start with the markets that are the deepest and the broadest in terms of, the exposure that they want to build. And clearly that gravitates towards the US in terms of a big part of their portfolio. But I will say that, most Asian LPs have an allocation to Asia, continue investing, some of it may be more domestically focused in terms of what they do, but clearly by being out here in the region, they tend to understand local economies, local markets, and have relationships with local GPs over here. So we do see in a fair number of markets here in Asia Pacific where they have stepped in to be backing, GPs or creating portfolios that do work for them in backing Asian managers.
Sunil?
I think the only thing I'll add is that, as Hemal mentioned, whenever you start investing, you start with the most significant markets. And China has attracted fancy of, Western investors and also Asian investors. So most of the Asian investors we speak to, they already have some thoughts around what they want to do in China or when they want to do it in China. So, it's clearly they're stepping up, and I think it's in response to the great return that people are making there. And the great story that's available. And second is, some of the other markets which are slightly smaller and, either you have home bias and you're present there and you think that, you can do it very well. So people have kind of stepped up doing a bit more direct approach there, might not be all in private equity, but, maybe in real estate, maybe in infrastructure, but, on the, what I call illiquid private asset class. So people have stepped up as the knowledge about the industry and knowledge about making some of their long-term return thresholds meet. So we definitely see that.
Okay, let's talk about Southeast Asia. HarbourVest set up an office earlier this year. Sunil, you talked about the exit landscape. The SGX, the Singapore government itself is putting its might behind making the listing avenue more attractive to startups. What do you see is the opportunity in Southeast Asia? And what are the challenges that you see in terms of deploying capital? And Sunil, maybe you could go first.
Okay, so we have been based here for long time, and and one was the view that we thought that Southeast Asia market would be interesting. Took slightly longer than we thought, but it is an exciting time. We have been investing in growth and buyout in Southeast Asia. The venture story has kind of become a lot more exciting over the last 5 to 7 years. And given what we are seeing in terms of the demographic digital penetration and this whole COVID digital acceleration that we are seeing in Southeast Asia is not untouched by that. So some of that story is playing out. Maybe now, maybe 6 months later, Grab will probably have a SPAC listing, and Gold is expecting to have SPAC listing or direct listing. Each of those would be, in my mind, pretty eureka moment for the Southeast Asian tech. Large scale outcomes, which kind of will definitely catch the fancy of some of the traditional tech investors, which has been kind of absent. There have been a lot of VC activity here, primarily funded by angels and family offices and corporate venture capital, but has lacked the traditional early stage investors, which you saw in the US and then later in Europe and China. But I would say, it's a great step by SGX. I think it's a lot of funds are based out of Singapore, or definitely maintain a very strong presence here. And Singapore has done a great job, I think, in terms of jumpstarting this ecosystem. Going back all the way to running the ESP program, and then through several of the matching grant schemes that they've run. And clearly that fruit is coming to bear there. I would say exit avenue is important. While really large outcomes and large companies can go to the US and get listed, having some I would say a place where you would say mid-sized outcomes are possible to be listed would definitely increase the interest of investors once they're able to see the whole cycle being played out. So I think it's an exciting move, but we still need to see who are the companies who list here, whether it will be dual listing, whether it will be single listing, and of course what the investor appetite is. But going by what we saw in Zomato in India and Bukalapak in Indonesia, clearly there is a lot of interest in technology assets which are fast growing. So hopefully this momentum can continue.
So I'll just add, for HarbourVest, that commitment to Asia continues. We started with the single office in Hong Kong in 1996. Tokyo came next. We've had Beijing, we've had Seoul, and Singapore next, just in terms of following the development of markets, which I think is fantastic. Sunil covered really a lot of exciting developments, but what I'll say is that, Singapore's done a great job of being the right regional headquarters for a lot of what can come from Southeast Asia. So bringing talent over here has been quite interesting to watch in terms of, the mix of China, India coming together in Southeast Asia to take some of these business models to look and adapt for local countries and see how you can build something with the big population that we've got, out here in the region. So we remain very excited about opportunities that we're doing here. You've got to ask yourself, was I crazy to make the move in the middle of a pandemic? But it's we all have busy lives. It's never easy to do some of these kind of things. So I am excited to be over here and continue to build really relationships over here and look to deploy capital in the region as well.
Sure. Sunil, this is more aimed at you. In a previous interview, you've said that Indonesia and Vietnam are attractive markets and could potentially merit a country-specific fund of their own from your firm. What are the challenges at the moment? And again, what are the opportunities that you see that you would like to capitalize on?
No, so yeah, I did mention that, and we do this analysis every 2-3 years about what we call regional fund markets and country fund markets. and they are specific to strategies and also specific to markets. So our current assessment is that these are specialized and deep enough markets where there is a lot of country-focused activity happening. It's for us to make our assessment whether it is attractive for us as well or not. And we are of the view that I think these two markets will be able to sustain country-level funds. We have made commitments to Indonesian market and country-focused funds. So remain excited about that market. We have not made a commitment to a Vietnam-focused fund yet, but it's not for the lack of trying. We've been trying. But like I said, in a global setup, there are a lot of great ideas. So we've just not been able to get to the finish line. But I think that both these markets have some very unique features, slightly different from each other as well. But large private markets, some unique characteristic in Vietnam, how they have kind of come up over the last 10-15 years. You're one of the fastest growing markets, close to 100 million people. So we think there is going to be a large domestic economy, and very young population as well. So large domestic consumer oriented economy, things that we like, because we are investing for medium to long term. We are invest over a period of 7 to 10 years and probably see results over the same time horizon. So we like that part. I would say Indonesia, historically, there were a lot of resources focused private equity. That's something that we do less of. But as the kind of economy has grown, and I would say affiliated sectors have grown, our interest has deepened in the market. And clearly today, with where we are with the technology and healthcare, Indonesia is a really attractive market. So we remain excited about both of them. I think right now it's just a matter of relative merit. There are a lot of great ideas we have for Asia. We have a lot of great ideas globally as well. We just got to get to the right manager selection in specific vintage.
What advice would you give to? Sorry, Hemal.
No, please go ahead. No, please go ahead.
What advice would you give to fund managers in the region, in Southeast Asia, who might be looking to raise capital, based on what you've seen so far?
So I would say, historically, Southeast Asia issues have been around liquidity and performance, and it's not easy. There aren't many avenues for exit. It's not I would say it's an easy market to do recaps or trade sale as well. Even the IPO avenues have been limited, but all that is, it's kind of incrementally getting solved. I would say, there is no transformation, but it is incrementally getting solved. And also the manager maturity, as I mentioned, a lot of people were, raising first-time funds, 1, 2, 3, and now they're in 3, 4, 5. Clearly, lots of scar tissue, lots of lessons learned. People starting new firms as well. So we remain excited about the quality of the opportunity. I think the macro opportunity was always there. We just needed to see a bit more of LP returns, and get excited about that. And I would say, I think it's kind of getting there. We've had some exposure, but we are hoping that over the next 5 years we are able to kind of build on that exposure.
Hemal, impressions so far?
Yeah, I'd say the other thing that GPs have done well is the communication has been great. I think we hear a lot more from GPs who want to talk about growth. They want to talk about where their value creation is coming from. And I think this time, whether it's because they're on fund 3 or 4, or whether it's because they're setting up new firms, as Sunil said, I think what's also coming together very nicely is that there is much more of a Southeast Asia strategy than there was. Earlier you would see funds that would say, here's what I'm doing in Vietnam, and here's what I'm doing in Indonesia. And you'd sort of say, okay, so how is this going to grow? Or how is this going to scale to the numbers that you want to get those kind of outcomes that we're looking for? And today you're finding that managers look a lot more to get a pan-Southeast Asia strategy for businesses that they're backing, aiming for those kind of outcomes right from the beginning. So I'd say, both of these things are things that we've observed in addition to some of what Sunil highlighted as well.
Okay, maybe moving to India a bit, and exits, its record on exits has been patchy as well, but we have the Zomato IPO, we have other listings coming up. How has your view sort of changed about the market in terms of the exits? I mean, the opportunities in terms of the fundamentals have always been there, but in terms of exits, has anything changed? Sunil?
Oh, okay. I thought Hemal can go first. No, to be honest, we've been investing in India for a really long time. It's probably one of the longest investing market for us in Asia. And we have built our portfolio very gradually. And it was exactly because of this that, exit avenues were limited, and the private equity in early days was highly undifferentiated, actually, to be honest. Everybody was doing exactly the same thing. But 10, 15 years on, I think there is stratification of strategies, and there is a general maturity of managers in terms of their toolkit. To be honest, I think it's very difficult to negotiate with Indian entrepreneurs who think that they know it all. Okay, so you need to be really, really good at being able to communicate what you can bring to table to them. Otherwise, you will probably end up paying a very high valuation and never be able to get your money back. So I would say the exit market has always existed. Indian equity markets are very strong. Historically, to be honest, it was a competition to private equity. But as the equity, I would say the IPO market has matured, I think it has become a lot more collaborative for the private equity managers. There is a space for private equity managers, and there are certain situations which are more suitable for IPOs versus investment by private managers. And of course, the evolution of the value add capability, or like you can call control investing, buyout is still slightly limited because there is no onshore leverage really available. Control investing has also improved your ability to control your own future, because last time you were probably dependent on whether you can get support and cooperation from the founder to be able to get your exits or not. And clearly the venture story has played out really well. We all were very hopeful when we started in early days. The ecosystem took a while to develop, but I would say there is a strong, you can say, appetite from the global investors, which basically first manifested in secondary exits that we saw, the Walmart exit, or the Oyo exit for the early stage guys. And I would say, to be honest, 15, 18 months ago, I did not think that India can have a listing from a tech company who's still not profitable, when they are so profit focused, the equity markets. But I think they're taking leap out of the developed markets in terms of backing these tech disruptors who are actually disrupting the I would say it's the traditional economy. That's not called the old economy, the traditional economy, in a very, very new way. And there is an appreciation for that. So we probably, hopefully this momentum can continue. We'll have few more of this. I know there are at least 12 of them which are already lined up for subsequent IPOs. And if it does well, I think this will definitely be very, very beneficial for investors, for entrepreneurs, especially because in India, the Indian companies cannot list overseas directly. So it's kind of a handicap when you compare it to, say, a China or Southeast Asia or rest of the Asian markets. So that was very important to get validated. So remain excited about it. I think we have built a decent exposure there, and hopefully if the results continue, we can probably back more managers.
Yeah, so I'm a bit tired of calling it the cycle of hope and disappointment, because that disappointment, used to eventually come about, and so I am hoping this time it's going to be different. I know you're not meant to say that, but I am hopeful that this time it's going to be different and open up some of the floodgates of unleashing the potential, right, that we've got, in India with that ecosystem. I think it's also been a particularly challenging place to earn returns because of the currency. I think that's one of the issues that we've all got to deal with, where US dollar investors at the end of the day, we're not Indian rupee investors. And so earning that US dollar return becomes very important. Again, as we talked about in terms of global allocations and where capital is going. And I think if we can see the kind of returns that, some of these new companies are able to deliver, I think it will hopefully break through some of the challenges that we've had in the traditional economy and being able to deliver those kind of returns from there. I'd say that, manager quality and manager talent is continuing to mature over there. I think there is a better understanding of what investors are looking for from the markets as well. And I think there's an understanding too of the kind of returns that they need to deliver on a consistent basis, right? It cannot be just a single deal that builds that track record. It's got to be consistently. So, we LPs, are difficult. We want to know what you've done for us lately and not about an exit that took place maybe 3 years ago. It's got to happen more frequently than that. But I am back in that cycle of hope and watching to see what comes next in all these IPOs that are planned.
Okay, changing gears a bit on, let's talk about direct investments versus fund-of-fund investment. How's the balance shifting, if at all? And do you see value in increasing direct investments in this region? Hemal, maybe you could take that.
Yeah, so I'm just going to, I guess maybe just make clear that what we do is co-investments, right? So we are not direct investors where we would compete with any of our GPs or we would go out and bid on assets ourselves. We very much view ourselves as value add capital providers to GPs that we work with, who we have underwritten in terms of a fund commitment. So, to the extent that they have transactions where they require more capital and they want a partner on their side, we certainly would be more than willing and happy to partner with them. So, I just want to make that distinction clear between direct investments and co-invest. I'd say that, appetite for co-investments has definitely increased globally. It's not just in Asia. It is, we're seeing that increasingly from many of our investors who want to continue to act on co-investments. And, they are becoming, more partner-like in terms of wanting help. Sometimes it is very hard to be doing that across the globe where you may not have teams set up to do it. So, in many ways, we become execution partners for many of our investors in terms of looking at opportunities here in the region. So I'd say, they're growing. They're becoming a lot more growth-oriented in terms of the type of deals that we're seeing in the marketplace over here. And I'd say that the other thing that is becoming increasingly clear is that the amount of time that you'll end up having to complete these transactions and partner with them is also shortening, because I think there has been a lot of deal flow for the GPs in the region.
Okay, Sunil, on direct co-invest and fund-of-fund investments, all of them.
So, our investment strategies are two buckets, the fund investing and the direct investing. And then I would say in direct, one of the key parts of the business is very similar to co-investment that Hemal talked about. But we have two other direct strategies. One is in private credit, which is at this stage mostly focused in developed markets. And the third one is, which is where our root is, which is the direct venture growth equity. And at this stage, we are in early innings in Asia. Again, the strategy is designed not to be in conflict with any of our GPs. Most of our early stage investing is through funds. So we kind of, work alongside them, probably at a stage or two beyond after them, coming into the similar companies. But on the private equity side, most of our focus is working with the GPs, and most of these GPs are top tier GPs. So we want to minimize conflict and not be competing with them on the deals. But yeah, very active on the co-investment side, across all these markets, and and trying to be a great partner with these GPs on executing these deals. But I can say that I think a lot of LPs are trying to build direct practices. It's not us and Hemal. We probably are the most GP friendly players in these markets. But there are a lot of traditional LPs who have focused on building direct investment practices. So it is a trend that's going to continue in my mind, as people choose the strategies that they want to be in through fund and versus direct, or the markets, or they want to completely change themselves from fund investors to a direct investor. There are sort of examples of that as well. But we think it's really fraught with conflicts. I think you gotta make up your mind what you want to do. And GPs are very mindful, especially the top tier GPs, who have great track record, great access. They want to choose their partners well as well. Yeah.
What about the secondaries market? Do you see that picking up in Asia as well?
Yeah, absolutely. So I'd say that that's one market that we're seeing a lot of growth. for a secondary market to develop, you need to have had a very robust primary market, right? So you would have had a lot of fundraising that took place, GPs that raised capital and that had invested, and some time needs to go by before a secondary market develops. We focus a lot more on the complex side of the kind of deals that we do. So not just traditional buying from investors, we look to create a fair number of deals. And we've spent a lot of time over the last several years being very, very active in terms of creating those kind of deals. We were talking about China and frankly speaking, risk aversion. We're seeing a lot of secondaries come out from the China market. And frankly speaking, we're very interested in finding some real gems out of there that we could get at good value in terms of continuing to build the portfolio. We have a dedicated team out here in the region that focuses just on secondaries. And I think that's a team that's going to continue to see growth for us because there is a lot of deal flow coming through. I will admit there's probably some stuff that you never want to own, in terms of some of this that's been sitting around for a period of time, but we remain quite excited about opportunities that are coming throughout the region over here. Our ability to then build diversification, because you're building backward diversification in terms of buying assets that were invested several years ago, but then also being able to regionally pick your spots, right? We talked about India not, being a challenging market. If I could pick something that is closer maybe to liquidity than making a primary investment, that is an interesting way for us to build a portfolio and give our investors the right kind of exposure from a geography perspective, a vintage perspective, as well as then sector perspective in what we're looking to do. So we remain very, very excited about the development of the secondary market.
The only 2 points that I'll add is that, for a long time, Asia's private equity is about 15, 20 years old. And many of the, LPs were still building their Asia exposure. So there were not a lot of people who were actually trying to get rid of their Asia exposure until there are some strategy changes and stuff like that. And then there are, so I used to say that, there is good flow, but, the quality is very low. Okay. And that was the case for secondaries for a long time. And like Hemal said, some of that stuff you don't want to own. And whenever the quality stuff came around, it got bidded at nosebleed level by the capital. But I would say there is good level of depth, maturity, and activity which is going on, which is very good. And second is secondary globally is definitely changing in terms of perception. It used to be considered if you want to do a secondary or something must be wrong with you. So there was a stigma around it, which has kind of gone away. Some really high quality managers, continuation vehicles and stuff like that is happening. So I would say secondary market will offer opportunities of liquidity for traditional GPs, traditional funds, which I think is a good development as well. So we are expecting to see more of that as well. I think clearly there is a lot more going on in the US and Europe. Asia is just starting, but that'll be something to watch.
Okay, for my last question, I would like you to talk about one opportunity that you're excited about, if you had to sum up the Asia opportunity in a sentence or two, and one challenge that you think remains the biggest hurdle to more capital coming into this region. Hemal?
In terms of what more can we do to get more capital coming into the region, I think a lot of this continues to be about positive experiences that everyone has out here in Asia, right? So the more that you have, the more that you talk about it, it creates enough of that continued confidence, enough of that trust, and enough dialogue that takes place in order for more capital flows to come this way. You also want the returns to stay at the level that they are. So people do see that, outside of the US, there are other markets that can deliver the kind of returns that we're talking about as well. So I think continuing on that cycle of what we have seen over the last several years in terms of returns and the growth of Asia, I think is all positive in terms of, continuing to have more capital come out to the region. In terms of an under the radar market or, opportunity, more than under the radar, I guess, one of the things that we continue to be excited about is really talent that wants to set up on their own, right? And spending time with emerging managers or spin outs. Someone that's been at a firm maybe 10, 15 years, has developed a good track record and wants to set up something on their own to go and build a slightly different kind of business, or to have investments that are going into a new area. We get excited about, being with a managing partner at the start of their journey in terms of building a business. So we do spend a lot of time just in terms of tracking deal doers, what are the successes that they've had, and just sharing a little bit about the ambitions that they have. And that continues to be, a nice big pool in Asia of managers that, we can anchor in many ways in terms of their new plans.
Sure. Sunil?
I think we are really excited about the technology and the venture opportunity. Something that the firm has a long heritage in, and we have been investors across the market over the last 45 years, have very successful track record there. And in the Asian opportunity outside of China, to be honest, China is kind of a proven venture market today. And we have invested a lot and done really well there. But, in the rest of Asia, that venture opportunity is just kind of, just bubbling up. So really remain excited about it. COVID has really brought healthcare to the fore. It was one of our investment themes globally, even before going into COVID, for different reasons. But with COVID, clearly, it's right in front right in front of everybody. Whether it is quality of care, whether it is quality of medicine, all those things are front of center. So I think that would be the opportunity that we are very excited about. In terms of risk, I would say, at this stage, these are large, deep markets with proven track records. A lot of manager maturity which is available. So I think the only risk is, if the performance doesn't continue, then there'll be some biases. Which
don't say that, Sunil. We need these markets to continue for a while.
Yeah. So if I'm with you, Hemal, completely. Fingers crossed. I think that is the only risk. Because people do expect Asian markets, given the inherent growth. And some risk around currency, a little bit of socio-political risk and all, slight premium. And the markets have delivered that. They consistently continue to deliver that. There is no reason why we shouldn't be having a flourishing Asian private equity.
All right, that's it for this session. Thank you so much, Hemal and Sunil, for all your insights. Thank you.
Thank you.
Thank you very
much.
Thank you.